на финансах. Позже Массачусетский технологический институт в 2007 году и PhD по финансам. С 2007 года работал в университете Мэриленда, а сейчас в Российской экономической школе, как я понимаю, да?
Точно.
Пожалуйста.
Но если у нас примерно один час, все-таки специализировался на кафедре исследования операций.
Да, исследования операции на научных военных морозов. Мэрилендский университет, я не знаю, кто-нибудь знает, где вообще находится Мэриленд в Штатах? На западе, на востоке, где-то там в центре, или где этот штат находится?
Не на побережье.
Не на побережье. Ну, ничего, что думаю. Ну, в общем, на самом деле, Мэрилендский университет находится в Вашингтоне. Вашингтон, DC, столица Соединенных Штатов Америки, поэтому мне там было очень интересно находиться все последнее время, когда происходило много всяких интересных финансовых кризисов. Я приехала в Вашингтон, собственно, произошел финансовый кризис. Потом было много-много лет очень интересно посмотреть вообще, что американское правительство делало в такое неспокойное время. И потом, как бы, сейчас уже все как-то так, кризис особо никуда не делся, но, по крайней мере, все так успокоилось, и, в общем, как бы, я решила уехать. Так что тоже...
То есть вы связываете кризис с вашим присутствием, тем, когда вы уехали, все будет нормально?
Пока я там была, нет, там было много всего интересного. Сейчас как-то последние несколько лет уже так, менее интересно с профессиональной точки зрения. But let me speak in English. Let me switch in English because it's still easy for me to speak in English rather than speak in Russian. I was told that in 1-2 years it will be easier for me to speak in Russian. So, but for now, I'm speaking English. And I want to talk about Microstructure invariance. It's sort of the main sort of topic of my research, on which I work with Pete Kyle, who has been my mentor, at least at Maryland, my colleague, my friend, and we work together on this ideas. If you'll be interested in this, we have sort of the main paper that we are revising at this moment, and also where we sort of outline our main theory that I'll discuss today. And then we have a bunch of papers, sort of follow-up papers, with a lot of empirical evidence, usually empirical evidence that supports these ideas. So, how should I? Okay, so in general, you know, if you look at financial markets, I don't know, did you study a lot? How many? Like, did you have a lot of finance classes?
Yes.
Okay, so you know, did you talk already about what were the topics that you have discussed with your friends in finance? So did you talk about like the KPM, for example?
About what, CPM?
Yeah.
Yeah, of course.
So what else do you know in finance?
I think that it's a financial department, and so we studied a lot of fields of finance.
Okay, so you probably studied like corporate finance,
yes.
Asset pricing. Did you have some classes in microstructure?
Yes.
Did you? Okay, so microstructure is a subfield of asset pricing that focuses sort of on high frequencies. So the main concepts in microstructure will be, you know, trading, because you can think about financial markets as sort of this big trading games that people play. So there can be a lot of traders, they may have different information, they may trade based on this information. Other people will be trying to figure out what other traders know, and they'll try to react. And these are complicated games that people play. So market-like structure is about those games. And the main concepts that there will be, usually it's information, trades. Trades reveal information. So when somebody buys, other people may think that maybe there's some positive information, so we'll have to adjust our valuations. So it's prices, so it's information, trades, and prices. So this would be three main concepts. And market-like structure is the field that studies how these games work. So it's about transaction cost, pricing, bid-ask spread, optimal trading strategies. So this is the big field, subfield of asset pricing. If you look at different securities, if you look at the marketplace for different securities, you'll see that they look quite different. So you may have stocks like Apple. This will be very actively traded security. There will be a lot of people trading the security. They'll be reading news. There will be usually like a bunch of news articles about the Apple every day, and there will be a huge trading volume, many transactions in Apple. Maybe a small bid-ask spread. So people would say that this is a liquid security, pricing and transaction cost are low. So this is sort of one market, and at the same time you may have you may look at some other security that maybe was issued by some small company that nobody knows. Nobody will know even the name of that company, and maybe there will be like one trade per day, and maybe there will be like one news article per month. Maybe some journalist will decide finally to write something about dividends that this company has paid. So, so these two markets, in some sense, will look quite differently. If you collect all of the data, you can collect, for example, what sort of data we have in market structure. You can collect, for example, the number of transactions per day in each security. You can collect the average size of transaction, median size, different percentiles. You can collect information on bid-ask spreads, pricing, and if you put this data in one huge data set, you'll see that all the data looks quite different here. And I would say that there hasn't been a theory that will sort of that will explain what happens in those markets. How bid-ask spread and liquidity, for example, is related to volume and volatility of the security. So what we want to do in this project is to come up with some theory that basically will explain everything in market structure, or at least this will be the theory that will work in some ideal world. So we think about it as a benchmark that will capture a lot of variation in the data. So we don't expect it to work perfectly. There will be always some deviations, but it will be a very good benchmark, as you will see. And our main idea is that these markets, small stocks and large stocks, for example, they are actually the same. So because it's it's sort of we say that basically it's the same trading game that is being played in each of these security. The only one difference is the speed with which these games have been played. So in active security, you'll have these trading games played fast. So maybe there'll be many trading games played during the same calendar day. But in inactive securities, there'll be maybe one game played during one calendar day. But if you actually look, if you take this small security, and if you look at 3 months, for example, of small security, and compress this 3 months into one day, you will get something that will look like trading an active security in Apple. So fundamentally, this game should be the same because ultimately it's the same game. It doesn't matter which security is traded. It's It's like the game should be fundamentally the same. So there should be the same set of rules that will, that will describe what happens in financial markets. And this is all related to, this thinking is not new. This idea that you can change the time, how quickly the time clock ticks, and maybe you can get something that will look invariant. So it's not exactly new. This idea of transforming the time clock, but we do it in a way different from how people used to do it in the past. So the idea of people playing trading games, this concept of trading game was first introduced by Jack Trainer, who's still alive. So he's actually he's probably like 90-year-old now, but he's a very famous person. Maybe not in academia, but certainly in industry. So in industry, probably he's like if you ask some sort of big bosses in Goldman Sachs and Morgan Stanley, like who's the most famous finance person, those who's living now. Probably they'll say Jack Trainer, because it was actually Jack Trainer who came up with the idea of the CAPM when he was a PhD student at MIT, but his advisor sort of said that it's not interesting. And it was Jack Trainer who sort of gave this good idea to Fisher Black, about Black-Scholes and dynamic duplication, because it was Jack Trainer who was the mentor of Fisher Black and who taught him finance for sure. And Jack Trainer was also the person who, and he's the person who studied market microstructure, because this paper that he wrote in 1971, it's a very small paper, it's like 3-4 pages. There's sort of no formulas, but it's the first time, it was basically the first paper in market microstructure in which he has been thinking about what determines the size of the spread, the spread, and sort of describing in words this game about informed people and noise, and uninformed people and market makers who are trying to break even. So, so this is sort of one of the examples of the trading games, but then in market microstructure, the field has developed, and those of you who studied market microstructure probably saw a lot of models in market microstructure, more sophisticated models. So this would be just another way to model trading games. The idea of invariance is that you need to take those models and just apply them for different time horizons. So you will need to apply them, for example, for 1 day in active stocks. And then you have to take the same models and sort of stretch them out for 3 months, for example, for small stocks. But when you write down the model, quite often you'll just have one period, for example. So you'll have time 0 at the beginning and time 1 at the end. But nobody tells you what does it mean? What is it that time is equal to 1? Are we talking about 1 day, 1 month, or 1 second, or 1 nanosecond? So this is invariance is telling exactly what is the horizon at which you have to apply all those models. Okay, so let me. There are different ways to describe invariance, but let me just give you the example of what exactly it is based on some reduced form approach. So suppose that, and you can also derive these relationships that I'll be telling you about in a more sort of general equilibrium framework that is more conventional in market structure. But suppose that there are these traders who trade some security and they place bets. So the bet size, bets arrive according to the Poisson process, and the RL rate is gamma, and Q is the size of bets. So Q is in shares. It can be large, it can be small, it can be positive, it can be negative. So
how can it be negative?
when Q is positive, it's like the guy, this trader wants to buy. If it's negative, he just wants to sell.
So you mean short position?
Yeah, basically he wants to sell. He can sell or buy, and we sort of assume that on average it's zero. There is sort of no asymmetry there. And when we talk about bets, it's a complicated concept. It's not exactly the order. It's not exactly the trade. It's more like idea. So it's like somebody gets a new idea, and a bet is this new idea. So, yeah.
Just this stupid clarifying, but suppose I'm just, I have no idea, but I only know that I need to rebalance my portfolio, right? So I need to trade 10,000 shares, right? Would that be my bet?
Yeah, this will be your bet. So it's some sort of, the main feature of bets is that these are sort of independent decisions. It's a Poisson process. Remember the Poisson process, each time you have the independent draw. And this idea of independency, that's the most important thing.
So it does not necessarily have to be related to any information?
No. So we don't want to say that these bets are informed or uninformed, because in more conventional Microstructure papers, you have noise traders, prompt traders. So here we don't want to talk about this. It's just some bets, some new ideas that and it's complicated to map ideas into data. So what do we usually see in the data that comes from financial markets? Well, usually we have something that we call the tape. So the tape is, every time whenever there is a new order placed in the system, or whenever there is some new trade, it will be recorded on the tape. So the tape was just this thin strip on which information was recorded and then maybe transferred by telegraph or somewhere in the past. But it's still called the tape. So the tape will have it will have prints. So what is the terminology here so that you understand what I'm talking about? So suppose that there's a hedge fund manager who is doing some research, he has some sort of great idea and he's running these regressions, trying to figure out some special signals that will be predicted on which stock is underpriced, which stock is overpriced. So suppose he's running these regressions. And then he decided that this security is underpriced based on my regression model. And he says that, okay, so I'll buy, then it's underpriced security, I'll buy like 10,000 shares. Usually he doesn't do it right away. He doesn't go to the market. He doesn't buy 10,000 shares right away. Why do you think he will not do this?
Because he wants better execution.
Yeah, because if you do it right away, imagine you come to the market and you have this huge quantity on the market. So if it's a huge buy, all the prices will go up a lot, and you'll have to pay huge transaction costs. So you don't want to do it. Usually, these guys would try to sort of hide in the order flow so that nobody can see that they're actually buying. So they'll be shaded. It's called sort of shaded the order. So the original order will be shaded into many pieces, and will be probably traded in 100 share lots, because it's a minimum lot size. So it's a minimum number you can usually submit in the market. So on the tape, we'll see the information for each of that small trade. And sometimes even not the huge order. And it will be very difficult to reconstruct what the big order was to begin with, because we don't have identity of, it's rarely that we know the identity of people who, or ID numbers of people who have been placed in those.
But you do, right? You have a much better.
Yeah, so I'm talking just sort of in general. So I'll show you results based on my special data set where we have that information. But usually you don't observe those large orders, and it's very difficult to identify what the pattern is. And moreover, sometimes it can be the case that you can have one analyst who was doing some research and also, for example, decided that the company is bad and we need to sell. And then he will send the email to all of his clients saying, we need to sell the security. And then all of those clients, maybe some of them, will decide to sell. So the bet, to calculate the bet, we will have to aggregate all those small orders because it was one idea. It was the idea of that analyst who said that you need to sell. And all of those orders of the clients will be dependent. So we'll have to, in theory, we'll have to aggregate all of them.
I'm sorry, and what if, say, other traders come to exactly the same conclusion, but independently from this guy who first got this idea of selling the stocks?
It's like, as long as there's some independence, it's a new bet. So, for example, compared with the writing news articles. So we have journalists who are writing news articles. So a lot of the articles that were written, so usually there will be one guy who actually has been sitting there thinking about whatever's happening, he will write the article. And then potentially there will be a lot of other journalists who will be just copying what the guy said. So it's not that they did some independent thinking, they just copied what was there before.
And everyone have impact on market.
Yeah, this is different. So I'm more talking about sort of this new creative independent thinking. Yeah, and even in research also, there are not that many people who sort of generate these creative ideas, and other researchers will be just copying what has been done in some sense. So these other things will not call them bets because they are just replicating what was there. But going back to that example, if at the same time there will be another journalist, for example, who has been also sitting like on somewhere else, and he has been thinking himself and maybe reading on sort of similar sources, and maybe he'll come up with the same idea, that will be independent still thinking, so we'll say that it's a new bet. But you can see that conceptually it's a very shaky concept, so it's one of the shakiest concepts.
But quantitatively, as I understand, you just need it because you talk about statistical independence, right?
Mm-hmm.
Essentially.
Yeah, so...
What could be also interesting, possible interpretation, I don't know, possible interpretation for algorithmic trading. How to, could we do this with these bets or not? I don't know. This is a question.
Yes,
so
usually the way we think about, like, in this framework, we think about sort of long-term investors, asset managers, like pension plans, endowments, foundations, who sort of do this research and place bets. And the bets are intermediated by intermediaries, and there, we can talk about market makers, or maybe this will be stock art, such arbitrageurs, or maybe this will be high frequency traders. So they're sort of more reacting to flow, and they're sort of more intermediating whatever happens in financial markets. So, but the boundaries here are also very shaky. Whom do you want to, who is intermediating orders and who is actually placing bets? And sometimes one financial company can do both, actually. So it's also, but some of the start arb trades will be also, it can be a new sort of idea and a new bet.
Could it be important that they use the standard software or the one or two types of software?
So even if
have
you
advices from this software?
Yeah, potentially there will be a lot of correlation in this bets. So it can be. So then we'll be interested in the new independent increment. Okay. So, but let's just say that these are bets that there are.
So you allow for correlations, right?
We don't allow correlations here.
But in
yeah.
principle,
But potentially you can probably modify this to get to
because I
have
think
the
this is a very good point, it seems to me. I mean, if you just use that standard, any of the standard technique or even non-standard, your order flow is going to be correlated over time, right?
order flow usually is not correlated.
No, I mean, because you're going to trade, you're going to to follow certain strategy over a certain period of time, right? So it's self-autocorrelated.
Yeah, but that is like in college 5 order flow is not correlated. Even though informed traders has autocorrelated ordering, but from the perspective of the market, the order flow is not correlated. It's martingale.
No, I don't think so. It's
Yeah,
not market.
It may depend on time horizon we're speaking with, on very short term
No, it's
horizons or flow.
No, in college 5
It
it's
doesn't
not.
have to be martingale. It's a martingale if my
It's martingale under the filtration of the market maker. It's not the martingale under filtration of the prompt, but yeah, that's
no,
for
not
sure.
in this case.
But
it's okay.
but yeah, we don't have any correlation at
But
this
it's
point.
clear if everyone is doing the same thing, right? I mean, then things have to be correlated.
But the fact that market maker is always trying to predict what the order flow will be, so he will adjust the price to the level that nobody will, or at least he will not be able to predict
Yeah,
whether
Price,
next order flow will buy or sell.
not
Yeah,
price,
otherwise,
but not the order flow, right?
Yeah.
Maybe the price, yeah, I would
The order
agree
flow
that,
also.
yeah, there will be no, it may be the case that they can undo effects in
no,
price.
the order flow also
But
because
not the order flow.
because the order flow will affect price.
No, not necessarily. If it's
Right.
uninformed order flow, it has no price in it. Right?
Which one?
No, I mean,
Uninformed, in this world, in this world, it doesn't matter whether it's informed or uninformed. Everybody will have,
yeah, but you're saying,
flow will have
you're
price.
just saying order flow is a different story. In Kyle model, it's right. I mean, yeah, order flow does contain price, but in this case, it's not necessarily Kyle model, right? Because
In
you have,
this one?
yeah, well, okay,
Yeah,
he is
here
Kyle
we-
model, fine, yeah.
Yeah, I just had it like
just
in,
don't-
Maybe postpone long discussion.
Oh, sorry.
yeah, so,
That's fine.
but usually in many majors, order flow will be unclosed because and price will follow martingale. And here it's sort of we have that feature, but it can be loosened. But for us, bets are independent each time. There are independent bets.
Okay, but in that case, fine, yeah. So there's no correlation whatsoever.
Yeah,
Okay, then.
Yeah. So let me explain then what is invariant here. What do we say is invariant? Because so far I didn't explain you anything much. We are saying that this object is invariant, and this is we call it the risk transfer I, and it's price times Q. Q is sort of how many shares is in this bet, and then times volatility divided by square root of gamma. So volatility divided by square root of gamma, it's volatility in business time. And business time, we're saying that business time is running with bets. So what is, I have to say that gamma and Q would vary cross-sectionally. So for large stocks, Q will be large and gamma will be large probably. For small stocks, Q will be small, gamma will be small. So the problem is that how to determine that actually. And we're saying that gamma effectively and bets that derive at the rate of gamma, they determine this business time clock. So the more bets there will be, the faster will be the time clock. The lower gamma is, the slower time clock is like a small stock. And so if you take volatility and divide by square root of gamma, this is the volatility per time tick in that business time. Yeah? And then you multiply by price and Q. So this is like dollar risk transfer in business time per tick. So we're saying that this is invariant. We're not saying that volatility is invariant. We're not saying that volatility divided by square root of gamma is invariant. Like a lot of papers would say that it's volatility and transaction time that might be invariant. And the test, we don't say this. We say that this particular object is invariant. And it's a risk transfer. It's how much risk is transferred by this bet of Q shares. Everybody can see that. So this is one invariance. And another one is Microstructure invariance of transaction costs. So we're saying that if you don't have any this Empirical. But I'll just write some main contours. Yeah, so it's like if you have Q, so Q, this is in shares, this happens in shares. And then if you transform it into I, such that you'll take Q multiplied by P, sigma, and divide by square root of gamma, then the distribution of this object will be invariant. Like if you look at small stocks and large stocks, it will be invariant. If you just look at Q, you know, so if you look at large stocks and compare it with Q for small stocks. So for small stocks, Q will be very small. So maybe there will be like some distribution somewhere around here for buy orders and for sell orders. But there will be just a few shares traded. Large stocks, Q will be like probably huge. So maybe it will be like this. Now these distributions will be quite different because the size is different. But then we're saying if you sort of rescale it in this particular way, you will actually, if you plot again, you know, these distributions for large stocks and small stocks, but these are distributions for I. These are distributions for Q, and these are distributions for I. You will actually get something that is completely invariant. This is just a hypothesis.
Sorry, what is P? I have to look at.
P is just the price of that security. And then the next invariance is then if you look at what is the transaction cost of executing this bet, and this is CB of I, it's also invariant. So this is CB, it's the cost, it's dollar cost of executing a bet. It can be maybe like $200. So for if you do these transformations, then you'll get order size Q transformed into I, and then look at that invariant cost function, and it will be the same. So for example, if you take Q somewhere around here and here, that is being transformed into the same percentile of I, it means that these orders will have the same dollar cost. So maybe there will be some function, CB as a function of I. And
does it fit to the real data? Is it most assumptions?
These are conjectures, but then we test this in the empirical data. Yeah, and we have quite good results. So basically, as long as Q's, as these bets, are being transferred into the same I, so that they have the same dollar risk transfer, they will actually have the same dollar cost.
But what is transaction cost here? It's only commission of the market or also market input?
Yeah, it's everything. It's market input also, and we are mostly in shipping.
But how do you calculate it in practice?
So there are different ways to do this. The most conventional way, and that's the correct way to do it, would be to calculate the implementation shortfall. So before you start it, when you get the bet, you make a photograph of the price in the market. That's your benchmark price, and then you see when you implement your order, price will deviate. There will be some transaction costs, and you compare those prices at which you execute your order with the benchmark prices. And this is yeah. So basically, the implementation shortfall will be if you execute Q, you look at the average execution price, and maybe you'll subtract benchmark price, and that's the price before you start to implement this order.
It seems like this invariance concept does not really depend on sigma over square root of gamma, right? That's just a parameter.
Sigma over square root of gamma is super important.
But sigma over square root of gamma,
I can explain why. Because this is a scale effect.
Yeah. So that would let me show you. So far, actually, I'm just. I told you that.
No, wait. I'm just probably missing something here. But sigma and gamma, they are not random variables, right? They're just parameters that you extract presumably from the data.
You know, gamma, this is the
This is
Poisson
the
variable
Poisson.
rate, and you can change it, you can make it,
Right.
if
So
that's
for each
right.
stock, they're being fixed, right? No?
First approximation, you assume that you can assume that
The
they're fixed.
question, the problem is that Q and P are even for the same stock, they're still distributed, right? So we're talking about invariance of the distribution, then sigma over square root of gamma is irrelevant.
Yeah,
Because
so
you can
here,
just scaling up and down the same distribution.
here, you know,
It's not a big deal.
here basically, you know, just as a first way to understand this, and it can be relaxed. But think about price and sigma as some sort of, and gamma as some sort of constants
Okay, right.
for stocks. But this is not,
Scalar is important.
Yeah, but it's just scaling. It's the
Yeah,
same
but-
distribution being
but
scaled. Right?
Distribution of E is same, but not
Yeah.
of Q.
so if you look at Q, you know, Q basically may differ from one stock to another by a factor of like 10 or
The
100.
equivalent for QP.
By
No,
what?
but right, but I mean, if I have if I know the distribution is invariant up to some scaling factor, it's the same as to say the distribution is invariant, because the scaling factor you can restore from.
Invariant about.
But it's a
Cross-
particular
stocks
scaling
or
factor.
cross time.
Yeah, it's not like scaling factor different for each
No,
stock.
we compare different stocks, right?
It's,
So we take two stocks. For them, they have different distributions of Q and P, right? They're characterized by different distribution functions for Q and P.
suppose P is just.
Right, and they're characterized by different sigma and gamma that we extract from the data, right?
No, we can't extract.
But of the
Gamma is not observable.
No, okay, fine, but we assume that we can extract them, right? That's the point.
Well, it's sort of,
Am
Yes
I
and no.
missing something?
let me just continue because so far I have sort of shown you, you know, all these formulas, and I also told you that it's very difficult actually. We cannot observe Q and we don't know gamma because these are biased.
It's just, I mean, it's clear that if I have two distributions and there's just some scaling factor, I can restore it from anything, from
Yeah, if
normalization
it's,
condition.
I can see a point if we're thinking only about 2 stocks, for example, but if we're talking about 10,000 stocks, then what we're saying is that the scaling that we have to use is actually
Yeah, I
the
understand
same.
you impose an even more strict condition if you also want to control for that factor.
Yeah,
But
so we're saying
it's kind of, seems like it's a stronger condition than just saying that the distribution is invariant, right? Because it's not that its distribution is invariant, it's basically its numerical values are invariant at each point, right?
yeah, we show that there's one formula that you can use that
It's not just the functional form is invariant, it's more than that, right?
it's a distribution,
Yeah,
so it's a whole well, it's a distribution, and we show the formula that you have to use to make everything invariant, and so it's a very strong prediction. It's not just one distribution scale by a random factor.
It's kind of, if you take 10 of them, then basically.
Yeah, they're all
No, this
the same.
conjecture is surprisingly efficient. At the first sight, it seems that, well, it's...
Yeah, so let me show actually the next sort of step. Because the next step is actually, you know, to get this, to construct more reasonable tests so that you can measure something. And here we introduce this variable that we call W. So W is similar to our idea of event, but it's volatility times price times volume. So think about aggregated risk transferred per day. So this is price times volume. Volume is in shares. So this is how much of shares have been executed per day, which at times sigma. So this is how much risk has been transferred. So an interesting thing, and we can easily calculate this because we know volume, so we know price, we know we can calculate volatility, so we can calculate this. And an interesting thing to see is that you know, we can write volume as actually the product of gamma and the average size of a bet. Okay, because we have gamma bets, and this is the average size. So we sort of, you know, I have to say that this volume is sort of the expected volume that we sort of expect over the next trading round. So we can certainly write it this way. And even though we cannot observe gamma and Q, we can pretty much observe that product because we can observe W, trading activity.
Why do you include sigma into that product as well?
Because sigma is very important.
But you said trading activity, but it also includes the risk, right?
Yeah, because we think that this is the best measure to say how active security is, because usually people will be talking about dollar volume. They'll say when the dollar volume is high, it's actually trade security. But this is sort of not exactly true, because for example, in US treasuries you can have huge volume, dollar volume traded, but actually in terms of economic content, volatility is very small. So even though volume is huge, in terms of how much risk is being transferred, and this is the main function of financial markets, to transfer risk, economically not much is happening there. So that's why you know, sometimes people actually multiply volume by volatility, and that's what we also use here, and it fits our theory very nicely. So what do we do next? Next we combine our conjecture here. That's the invariance. We assume that it's invariant, and this one. So you can see from here, for example, suppose price and sigma are the same, and suppose that you go from small stocks to large stocks. So if gamma is increasing here, you know, maybe say by factor of 4, it's a square root of gamma. So in order to keep this ratio constant, it has to be the case that Q should increase by a factor of 2. So if gamma is increasing by a factor of 4, Q then should increase by a factor of 2, so that this 2 will cancel with each other. And in this case, how much will volume increase? So we have gamma more trades, and they're twice larger. So volume will increase by a factor of 8. Yeah. Yeah. So
It's going to be 4 to the power of 3 halves.
yeah. So this 2 is actually the same as 8 to the power of 1/3, and this 4 is the same as 8 to the power of 2/3. So when we go to larger security, it's gamma that is changing. Gamma is increasing, but also Q is increasing. But Q is increasing, so the gamma is increasing proportion to gamma, and Q is increasing proportionally to square root of gamma, because we need to keep this ratio constant. And so it means that, you know, so W is in some sense proportional to gamma in 3/2 power. Yeah, I mean, forget about sigma and price here. And so it means that gamma is proportional to W to 3rd power. So when, if somehow, if volume is increasing by a factor of 8, it has to be that gamma will increase by a factor of 4. And the rest will go into Q. So it's like, in other words, gamma will change proportion to 2/3 power, and Q will change proportion to 1/3 power. The product will be equal to W, but one is increasing twice faster than another one. And so this is sort of the main prediction of invariance, of the first invariance. By looking at trading volume and volatility, we can sort of tell you how many bets arrive after constant, and what was the size of the bets. This is quite a strong prediction. In terms of, sometimes we write the last line as QRV because usually asset managers will be talking about that trades in percent of volume. So that's why it's QRV. So QRV will decrease this minus two-thirds power. Okay, so this is one set of results. And another one is, how much time do I have? Because I told you that I can talk about this for like many days. I was not kidding actually.
Maybe 20 or 30 minutes more.
And
30 minutes.
we'll have a break.
No break.
No break.
So let me just go on a bit quicker because I wanted to show you some pictures, but we can derive similar things for transaction costs, for example. And it's very nice that actually transaction cost is function C of Q. The C of Q, that's the percentage cost. It's like in basis points, for example, like how much we'll have to pay to execute Q shares. Just believe me that you can write it by doing this really simple math like this formula. So it will be, the first one is sigma times W in minus 1/3 power. This is another interesting measure. We call it illiquidity. Let me say it's proportional because I don't want to go into this proportionality concept. But this is, if you think about this one, it's the same as sigma divided by square root of gamma. So it's like volatility per tick in business time. And the higher is this variable, the more illiquid security is. So this is for us a measure of illiquidity, and somehow the cost can be decomposed into 1/L times some invariant function. So this function is invariant and we're calibrating this, but it's interesting that it's the product of these two. So if you know this function f of I, for example, we're calibrating it in this model, in this paper, or maybe other people can spend a lot of money and a lot of resources to calculate this function. So then what they need to do if they want to calculate transaction costs for some particular securities and they know volatility and they know volume, they will just need to multiply these functions by this special sort of sigma and W in minus 1/3 power, and magically that's a recipe for them to get transaction cost function. So, okay, let me actually go quickly to the results. But this is the intuition. So here, on this picture, it's a small stock. There are two bets, two buy orders, two sell orders, and that one is a stock that has volume that is 8 times larger. So it actually, you can count the number of arrows. There are 4 times bets, and they're twice larger. So each arrow is twice larger. But if you, so this is calendar day. But if you look at 1/4 of the calendar day, you'll actually get something that will look very similar to 1 calendar day for small stocks. So this is, in a nutshell, that's our big theory here. Okay, so let me, we have we have actually a bunch of models. We now have, I guess, 3 models to derive this invariance results in in a more conventional way. But let me just talk to you about some of the results. So in the main paper that where we outline all these theories, we test our predictions using the special data set of portfolio transitions. And portfolio transitions, have you heard about portfolio transitions? So it's like, you may have pension plans, and maybe one pension plan manages like $10 billion. So those $10 billion probably will be delegated to some fund managers to manage. And each fund manager maybe will be managing $100 million. And then at some point, maybe this pension plan will be very angry and unhappy with the performance of one of the fund managers, and he'll say, okay, I'll just terminate your contract and I'll hire another one. Maybe it was the manager who has been managing, small US stocks, and somehow pension plan guy will say, I'll just hire another one who can manage the small stocks much better than you. So what will have to happen, the old portfolio will have to be liquidated, and the new one will have, or the new guy will be hired, will have to be acquired. And these are huge portfolios. Usually, it can be $50 million. Sometimes it can be on one portfolio, it can be like $1 billion. So these are huge, gigantic elephants in financial markets. And of course, there will be a lot of transaction costs. And there is a whole industry that helps. It's called portfolio transition industry, and there are companies that help doing this. So we have the data from one of the largest portfolio transition guys. There are about 2,500 portfolio transitions, and basically there are 400,000 of these portfolio transition orders. So we make a brave assumption that these portfolio transition orders are like bets, or at least they're proportional to bets. They can be, you can come up with the reasons why they should be larger. You can come up with the reasons why they should be smaller. Certainly these are institutional trades, but they're somewhat special because these are not typical transactions. But we suppose that we think that they are proportional. And what can we then do? So Q over V, that's the portfolio transition order divided by volume or security. And then if we just plot Q over V, then the distributions also, the distribution for Q will be different all over the place, and the distribution for Q over V will be also completely different across securities. But according to our theories, we're saying that if you take Q over V, and then we will multiply it, sort of rescale it by 2/3 power of W, then we will get something that has invariant distribution. Somehow miraculously, if our formulas are right. And that W star is just constant, so just some number convenient for us for scaling. So basically, the first thing we'll do, we'll just look at the distribution of this object, and we take all these 400,000 orders, we divide them into 10 volume groups, from small stocks to large stocks, and then we divide them into 5 volatility groups, from high volatility to low volatility, and we have these 50 groups. So we plot, these are all of our magical distributions. So there are like 5 out of 10 volume groups, and this is from small to large, is volume group 10. And from the first one, the first row is small, low volatility, and the last one is high volatility stocks. So there are 15 of them, but believe me that the other 35 are absolutely the same. This red bell-shaped curve, this is the same function everywhere, so that it's easier for us to compare all of them. Otherwise, these are empirical distributions. And so you can see that they're just all the same. Of course, there are some small deviations, and we spend a lot of time sort of looking at each of these small deviations, trying to figure out what is happening there. But basically, they're all the same. And these are distributions. The interesting thing is that this is
distribution of, I think, logarithm.
Yeah, this is the distribution of logs. So it means that if we plot it in terms of the distribution of Q, Q is closely related to log normal distribution. And it's actually bi-log normal. I don't know how it is called when you have log normal on both sides. So it's more like here this way and like here this way. So these are bi-orders and these are cell orders. Usually, in the models, we would say that the assumptions will be that we have a normal distribution. It's maybe like most traders who have normal distribution, but we can see here that it's not a good assumption. So we do a lot of, we do a lot of tests like this, basically. This is a super cloud that we just drew recently. Maybe I had to make it smaller, but so here on the vertical x, we have basically it's a log of Q over V. I guess we call it x here because it's a portfolio conditions. So it's a log of, think about this as log of Q over V, and here we have the log of W. So according to our theory, the slope should be minus 2/3. So this red line has a slope of minus 2/3, and we're just estimating the intercept. So you can see that here we have basically it's like 400,000 observations, and they all line up here very nicely along this line. They're slightly different. I mean, it's not exactly minus 2/3, and somehow you have more dispersion somehow on the right. And there are interesting things that you can sort of discuss why it's the case. As I was telling you, think about invariance as a benchmark. There are many market frictions that you have to take into account, and usually you can sort of explain many things by market frictions. Yeah, for example, if you look at that first chart, so this is quantile plot for empirical and log normal distribution. So if distributions are exactly log normal, then all of the points, this is like I'm talking about the first panel, all of them should be on this line. So as long as there will be some deviations, there are some small differences, and the small differences are related exactly to those small discrepancies on the previous picture that I had. It's not exactly a well-shaped function, but there are small differences. So for example, if you look at volume group 1, these are small stocks, and if you look at large orders, you can see that they're sort of, you have a line like this, yeah, and then it's more like here like this, and then it's more, it goes down here. So interesting. So you may ask why it doesn't go up all the way. Why there's small discrepancy. And if you actually look at each of these points, so we spend a lot of time like looking at each of that point. So if you look at that points, you'll see that usually it's like 3.5% of all of market cap, or maybe 4.5% of market cap. So it's never 5% of market cap. And 5% is a special threshold. So it turns out that APS, if you have institutional asset manager or somebody who is holding 5% and more, the guy has to report. So so it seems that sort of we put some cap on our points, and it makes our invariance not work in that particular little little tail. And there are a lot of stories like of a similar kind.
So we can say that small investors' behavior is different.
These are small stocks. We don't know exactly. These are actually all large investors, because these are large institutional asset owners.
But I mean, if you are holding a small portion of some assets, so in this sense, I mean.
Yeah, but it's like 5% of market cap. It's still quite a lot. I don't know how. I don't remember now the numbers, but it's not 5% of volume, but it's 5% of market cap, the whole company. And there are some, basically there is something happening there. The tail on the other side we cannot explain. So the tail in large stocks, somehow, stocks, you can see that orders are a bit larger than they should be. That's that last tail. So we don't know how to explain it. We couldn't figure out why those orders will be somewhat large, and it's actually it's a big puzzle why it's large a bit. Anyway, the type of regressions that we do like many things. Often we do this type of regressions when we take, we do just Euler's regression, statistically, we'll take the log of x or v on the log of w. And invariance would say, there will be some normalization, but invariance will say that the coefficient should be minus 2/3. Because you take logs, so what used to be in the exponent should be now the linear coefficient. And these are the types of, this is what we'll get. These are for different samples, all stocks and receivers, Nasdaq, buy, sell orders. But you can see that alpha 0 is, maybe it's not minus 2/3, but it's sort of close. And because our pictures were not perfect, that's why it's not exactly minus 2/3. So we can also have a lot of stories here. Because, for example, you can see that it fits better for buy orders. Yeah, these are new orders. So these are new orders, so we're using the right W. But sell orders, these are liquidations of all portfolios. Maybe those positions have been established 1 year ago or a long time ago. So sort of, one explanation is that we're using the wrong W for sell orders. So sell orders have to be explained by W that used to be like 1 year ago when those positions have been established.
Simply because, possibly it's not because of you better, because some necessity should sell your position, that's all. When you are buying, so you are betting. But if you are selling, it doesn't mean necessarily that.
But here, when you liquidate the position of the old guy, it's like that old manager, he was betting because he felt that these stocks are good.
Yeah.
And then something has happened. Well, probably he was wrong because he was fired, usually. So even though there can be other reasons for portfolio management, it's not always that the guy is fired. But it's interesting anyway. You can use invariance as a benchmark, and then so we can discuss all these deviations, why it doesn't fit perfectly, but still, statistically, of course, invariance will be rejected because you can see that the standard errors are very small, and statistically it's rejected, but economically it explains a lot. So we can do the same for all the different percentiles of the regression. We did a lot of this. We did similar things for portfolio for the implementation shortfall. So we can just it's also it's sort of complicated to explain the specifications, but it's like we'll calculate portfolio the implementation shortfall on the left-hand side. This is how costly execution was. Then we'll adjust for the market because the market could be moving at the same time. So that's why we have the market shown. And then this is our, this is our invariant. So we would say that that alpha should be minus 1/3 because it's this alpha effect, minus 1/3. And we do also a bunch of tests. So these tests, for example, are about quoted spread. So we just in the data set we have bid-ask spread. So we didn't have to get bid-ask spread. Usually it's complicated because you have to go into intradata and within the data calculate this. But fortunately, with this portfolio management data, we actually had a column with bid-ask spread. So we just use that number, and it's very close. It has to be minus 1/3, and it's very, very close. We run all types of regressions like this. So basically, what is my conclusion? These are, by the way, without going into details much, but these are 10 volume groups, and here we were trying to, calibrate this f of I, because we want to know what f of I is, because then we know this magical formula and how we can calculate transaction costs. And so these are these are our results, and they sort of look maybe different across securities a bit, but sufficiently close. So this is our f of I in some sense. We have square root model and linear model. But what are our conclusions? I'll maybe show you one more picture. Then, so this is these are our conclusions. This is based on the calibration. So for gamma, this is our formula for gamma. The red stuff, these are numbers that we have calibrated using our data. These 2/3 powers and W's. This is what comes from our theorem. So this would be, if somebody would ask you, how many bets are there in the market, you can just plug in into W, for example. Here, if you plug in 2% volatility, $40 and 10 million, this is our benchmark stock. So it's like that ratio of W with that stuff will be equal to 1, and it will go away. So it's like gamma will be equal to 85. So for the benchmark stock, our benchmark stock is somewhere at the bottom of the S&P 500. There are actually 85 bets executed per day. So there are like around 85 independent decisions there. And we can tell you what the transaction cost formulas are. So for us, it looks quite nice here. And we were quite excited about this whole research, and then we did a lot of theoretical research on actually trying to figure out what are the boundaries of invariance, and in some sense, what I showed you today is sort of the first order, sort of the simplest setup I could come up with, basically. But you can complicate it quite a lot, and it's still unclear what are the boundaries of applicability for invariance, and also theoretically. And we also did sort of a lot of research empirically, sort of also trying to figure out, for example, it seems that it works in US data, so it doesn't work in Russian data, it doesn't work in other data or in other markets. And I want to show you, just to finish with the, so we had a PhD student who was from Korea. He's from Korea, and he has been working on his thesis, and he has a super nice data set from Korea. In Korea, in South Korea, you have centralized exchange, and it's owned by the government, and they collect a lot of data. It's much better data than in the US. And he has the data, and he has been interested in high-frequency traders. He has been doing some research on that. And we sort of asked him to test some invariance results. So his data has, so you can see transactions, and you can also see accounts. So you can see who has been placing those transactions.
Usually it's some secret.
Yeah, in the US it's impossible.
Yeah.
I mean, sort of, he cannot. Well, he can see some identifiers. So it's not the person who has been placing the order. But in the US, even this is impossible. In the US, you cannot even say that, you cannot even reveal that somebody executed some order. This is already forbidden. And that's usually, there are no sets where you even have IDs so that you can actually see, that this guy executed this trade, this, so that you can recombine his order.
In his case, was it the public data or just his perspective?
No, it's a public. I mean, there are other Korean usually researchers who are using the data. But anyway, so what we asked him to do, like we said in China at some point. So what we asked him to do is to calculate the number of switching points for each stock and each month. So we asked him to take, for example, the count, and then look at the number of switching points. So for example, if the account is like buying, and it starts selling, this is one switching point. And then he's selling, and so buying again, that's the second switching point. So we asked him to calculate how many switching points is there for each guy, aggregate across all guys, and I forgot how many, he has like millions of accounts basically. I forgot how many. Yeah. So anyway, Korean people trade a lot. They trade much more than the US. So it's insane. So we asked him to calculate this number of switching points for each stock and each month, and then what will be our predictions? Well, we'll say that the number of switching points should be somehow maybe related to W into third power. So for large stocks, it should increase with 2/3 power. So we ask him to plot that picture.
So you identify the switching with the
That's the one.
over your bet, right?
Yeah, so again, linkages are sort of complicated, but you see it works. So he just, so this is the log of S, this is the log of switching points, and on the vertical axis, and this is the log of W. And you can see that, the slope is 0.67. It's exactly like 2/3, somehow miraculously. And the different colors are just stocks in different indexes like this, like KOSPI 50, KOSPI 200. So we didn't delete any points. We didn't delete any outliers that usually.
Because it is much more clean data.
I don't.
I think so.
I personally don't know the data. I didn't work with the data, so I have no idea what is there. But it seems to be quite good. So it sort of fits invariance. So if you think it's sort of a yeah. So there are still a lot of puzzles even with these features because yeah. So this is, for example, these are just all of the observations, and this is we calculated, for example, that coefficient, the slope for each year. So you can see it basically fluctuates around 2/3, and it's always sort of between 0.65 and 0.72, which is quite amazing. So, but let me finish here. I can answer some few questions, and you can invite me some other time so that I can talk more about sort of new stuff that we have been doing recently. But I hope that you'll be interested in something like that, and to make you think that there is something happening there. Something is. There are many questions still. If you're looking for some research questions, research topics, there are really a lot of questions that you can still do here, because it's completely unclear how much you can apply and what are the boundaries of all this.
Там были регрессии по двум биржам, а похоже, что они были разные. Нью-Йорк Exchange, NASDAQ. Есть какое-то объяснение, может быть, разумное, что они статистически разные были? В нескольких местах это было.
Yeah, so
Вот здесь.
for this one, well, in general, the two exchanges are quite different. So, for example,
Это одни и те же люди могут торговать на группе.
Yeah, but then, so NYC is more like organized exchange in some way, and NASDAQ is more like dealer's market, even though there's difference started to evaluate recently. But there are many differences. So, for example, even calculating volume is sort of not straightforward because you think that in NYC you can have buyer and the seller, and they will just transact with each other. And then there's a buyer who transact with the seller directly through the middle book, for example. And this is like 1 unit of volume. But if you do the same at NASDAQ, mainly the buyer has to go to, he has to go to the dealer. He'll have to sell it to the dealer. And then this guy also, he'll have to buy from the dealer, and this guy will have to sell to the dealer. And maybe the dealer will offset those positions. So basically, Nasdaq will report that there were two the units of volume, because there was one trade and another one. And that is only one, even though fundamentally it's the same. But there are a lot of differences in this structure. Nasdaq and NYC, there are a lot of different fees and rebates and
it can be easily explained because Nasdaq was not some times ago, it was not exchange. And the same things in Russia before merger of ISIS and RTS. So RTS was like Nasdaq.
Yeah, it's called dealer's
first of all,
market.
it was not exchange, then it became an exchange. But
It's just sort of it's a dealer's marketplace where you have dealers. So it's just another market structure, and it's interesting also. It's very difficult, even it's very difficult to compare NYC and Nasdaq. Usually there are a lot of studies. For example, studying is it bid-ask spread, where is it larger in Nasdaq or NYC, and it's difficult because the market structure is different, and so potentially you can use actually invariance, and securities are also different because Nasdaq will be smaller securities and NYC somewhat larger securities, and actually invariance may give some sort of benchmark for how to compare these two, but then there are still a lot of questions about what actually the volume is that you have to plug in into this in all these formulas. Maybe you have to deflate the volume in Nasdaq somehow by a factor of 2, or multiply this volume by a factor of 2. Or maybe there are more. Maybe this dealer, maybe you have the buyer talking to one dealer and the seller talking to another dealer, and then these dealers will also trade. So then we'll have like 3 units of volume. So there are many of these small, complicated things, but some of them we can explain, some of them we don't know how to explain. So.
I quite get an idea of switching points in Gaussian data, so that's how you come up with bets. But talking about your data set of portfolio transitions data, how do you map orders for portfolio transitions?
So we are just saying that they're proportional, and there is some proportionality coefficient there. This is the assumption. We're keeping that, it makes our paper quite complicated because we're keeping all of these multipliers, so it's sort of complicated to read our paper. But if you just multiply, the two, usually we take logs. So that multipliers will go into the intercept. So it will not affect this slope coefficient as long as it is constant. So now maybe it's not constant, then it will explain some of these results also. The fact that maybe the multiplier is not constant, or maybe you can think how to affect those results. Maybe that's why they're smaller and smaller in absolute value.
Okay.
But it's not straightforward because you can say that maybe these portfolio transition orders are too large because this is like liquidation of the whole portfolio. So maybe they're too large. Maybe usually bets are smaller. On the other hand, you can say, oh no, maybe they're actually smaller because that they should be because usually these fund managers will have a lot of other clients for whom they will be holding sort of similar positions, and so you'll actually have to multiply by something because it's small. So you can have arguments on both sides, and there's almost no way to check which one is true.
Thank you. And I wanted to ask one question. As far as I understand, this portfolio transition data is a record of trace of portfolio value. So it is, just one market participant executes trace of pension funds. So do you think that it can cast some doubt on an assumption of independence in bets? Because basically, this is one portfolio vendor. He may use exactly the same software and apply it to different markets, and thus make some bets dependent on each other.
I think the bets themselves will not be dependent because they, you know, the portfolio transition manager, he's just getting portfolio transitions from this asset manager. So he cannot change how much he buys or sells. That's his mandate. He has to buy this one.
Well,
But
he can change trajectory. I mean.
yeah. So all these tests are based on the aggregate. But what can happen here is that our results for transaction costs may be messed up because a lot of these portfolio transition orders are, or portfolio transitions are executed simultaneously, and that's it's kind of form basically when you start thinking about this. And it's probably the case that some of the portfolio transitions are so large that they move the market also, move some asset classes. We sort of control. That's why we control for the market, because just in case there's some market effect. But you know, you can execute portfolio transitions in small stocks, for example, and then the whole small stock, the whole market for small stocks will be affected. So yeah, it can be.
Еще вопросы?
I have some comment. I think that even if statistically it should be rejected, for practice, I think for practical purposes, for risk management purposes, and especially I think for performance measurement, it will be very helpful instrument.
Yeah,
Yes.
and you are studying risk management here. So
Yeah,
yeah, it has a lot of actual implications for risk management.
Exactly.
So I should invite you another time. I'll
Насчет
tell you about
статистической
market
значимости, уже у вас очень много наблюдений, поэтому надо не 5% брать значимость, полпроцента, поэтому не так. То есть, ну, часто. А?
Почему?
Ну, потому что это много наблюдений.
Ну да, то есть как бы...
Тест статистика профессионально не заметна. Чем больше наблюдений, тем скорее вы отвергаете гипотезу. Сколько у вас много наблюдений, вы любую гипотезу отвергаете. Естественно, поэтому все страшно.
So I also think that, я тоже думаю, что ничего, что ничего страшного. Как бы, если как бы можно еще подходить к этому с точки зрения Bayesian, да, то есть можно формулировать какие-то другие альтернативные гипотезы, и смотреть, какие гипотезы будут приниматься, и тогда любые альтернативные гипотезы просто точно будут reject совсем. А наша будет reject.
Хорошо, ну давайте, у нас по времени надо уже закончить. Какие-то вопросы, наверное, еще могут быть сейчас на порядке. Давайте поблагодарим докладчика.